Committee will come to order. Today we will receive testimony from the Honorable Randall Quarles, Federal Reserve Vice Chairman for Supervision, the Honorable Yelena McWilliams, Chairman of the FDIC, and the Honorable Rodney Hood, Chairman of the NCUA. Welcome to all of you. This hearing provides the committee an opportunity to examine the current state of and recent activities related to regulatory and supervisory activities of these agencies. It's been over a year now since the enactment of S. 2155, the Economic Growth, Regulatory Relief, and Consumer Protection Act, and the work of the agencies to implement most of the law's provisions, including the tailoring rules for U.S. banks and U.S. operations of foreign banks. Your agencies should also carefully review the existing supervisory frameworks and make any necessary adjustments to appropriately align them with the tailoring rules and requirements. On July 30th, 2019, all of the Republican Banking Committee members and I sent a letter to the federal banking regulators urging your agencies to finalize several outstanding provisions of S. 2155, such as the community bank leverage ratio and short-form call reports, and further tailor regulations to promote economic growth, including addressing the current expected credit losses accounting standard, the Volcker rule, the interaffiliate margin, and Madden. Thank you for acting on many of these priorities. I encourage you to continue exploring additional opportunities to tailor these rules. In that July letter, as well as an October 2018 letter to your agencies, several Banking Committee Republicans and I urged your agencies to revise the Volcker rule, including using your discretion granted by Congress to address the current covered funds overly broad definition. Although your agencies have joined the SEC and CFTC to issue a proposal revising several aspects of the Volcker rule, which is appreciated, the covered funds provision was left relatively untouched. I encourage your agencies to take quick action to address the covered funds issue by revising the definition's overly broad application to venture capital, other long-term investments, and loan creation. Separately, in September, short-term borrowing rates spiked as a result of large corporate tax payment coming due and $300 billion in treasuries hitting the market, even in light of banks holding a surplus of cash at the Fed, currently around $1.4 trillion. In light of these events, banks could have stepped in to alleviate the volatility in those markets by lending some of the excess cash that they hold at the Fed. So why didn't they do that? Some have suggested that certain aspects of Fed supervision and regulations imposed after the 2008 financial crisis may have exacerbated this problem, specifically the treatment of cash versus treasuries. Although the Fed has taken some steps to address the issue in the short term by buying treasuries and lending funds, it's important that the Fed review the details of its current regulatory and supervisory regime for potential long-term fixes. Now, quickly turning to guidance, Senators Tillis, Perdue, Rounds, Kramer, and I wrote to the GAO in February asking for its legal opinion as to whether 3 Federal Reserve supervision and regulation letters constitute a rule under the Congressional Review Act. In its October response, GAO concluded that 2 of the letters, including one providing a new supervision framework for large financial institutions and another related to recovery planning, are rules under the CRA and are required to be submitted to Congress for review. During the Banking Committee's April hearing on this very issue, I urged your agencies to follow the CRA and submit all rules to Congress, even if they have not gone through a formal notice and comment rulemaking, to continue providing more clarity about the applicability of guidance. I encourage the federal banking regulators to take a more deliberate approach going forward and take any necessary steps to rectify informal guidance that has not been submitted to Congress. In January 2019, the NCUA announced the portion of regulations that would be reviewed as a part of the process through which the agency re-examines all of its existing regulations every 3 years. The comment period for that review process has since closed, and I look forward to learning more about the regulatory recommendations provided to the NCUA and the roadmap for actions going forward. Finally, the Banking Committee has been exploring digital currencies over the last few Congresses, especially in light of the recent development of the Libra digital currency started by Facebook. In July, I asked Federal Reserve Chairman Powell about his understanding of and the Fed's role in the project. Although Chairman Powell noted that the Fed has set up a working group to focus on Libra and is in contact with other regulatory agencies, he also said that there is not any one agency that can stand up and have oversight over this. Given its scope, regulators across the globe continue to evaluate Libra, its potential impact in the marketplace, and consider appropriate, necessary regulatory responses. It seems that digital currencies are inevitable, and the U.S. needs to lead by providing clear rules of the road. During this hearing, I look forward to learning more about the status of addressing the overly broad covered funds definitions in the Volcker Rule, especially with respect to long-term investments, how the agencies are thinking through the recent turmoil in the repo market and what adjustments may be appropriate for a long-term fix, whether the supervisory framework that applies to banks currently needs to be updated and better reflect the changes made in the tailoring rules, and how the agencies are thinking about the Libra project, digital currencies, including what the U.S. regulatory framework what the U.S. regulatory framework merits consideration to balance innovation and protect users and privacy. I thank each of you for your willingness to join the committee today to discuss your agency's regulatory and supervisory activities on these important issues. Senator Brown.
Thank you, Mr. Chairman. Welcome to the three regulators here. I want to start by noting that typically when we have financial regulators testify, the controller of the currency is also here. Mr. Otting had a conflict today. I believe him. He's expected to announce changes to the Community Reinvestment Act shortly, changes that the civil rights community and others are very concerned about. I share those concerns. I expect that we will have him up before this committee, Mr. Chairman, to talk about this proposal and other activities at the OCC. So, good. Thanks. We all saw how Wall Street's financial schemes hurt regular people when they blow up in bankers' faces like they did 11 years ago. You all saw the devastation of the crisis, whether you were a staffer in the Senate, whether you were serving at the agency you now lead, or whether you were at a private equity firm after a stint at Treasury, you had a front row seat. You can argue about or discuss responsibility. We can talk about that later. That's why I'm concerned about the collective amnesia you all appear to have as you make changes in bank rules, changes that allow Wall Street to go back to its old tricks that I fear will again cost Americans their jobs, their homes, their life savings, and wreak the kind of devastation in neighborhoods like mine in Cleveland the next time that complicated bets blow up in bankers' faces. But what is sometimes harder to see are the schemes that hurt families and the economy even when they work exactly the way Wall Street intended them to work. My state is the setting of one of those Wall Street schemes. 12 years ago, just before the financial crisis, a giant private equity firm bought a nursing home company based in Toledo, Ohio, that operated facilities nationwide. Soon that nursing home company was being strangled by debt from risky leverage loans. It laid off hundreds of staff. It let its patients suffer under negligent, horrifying conditions. According to the Washington Post, staffing cuts meant there weren't enough nurses to respond to patients. Health code violations rose dramatically. In Pennsylvania, a patient broke her hip and crashed to the floor when a single staffer tried to do a two-person job and move her on his own. Patients faced other living conditions that no human being should have to endure, waiting in soiled clothing and dirty beds for help that was never going to come. And all the while, that Wall Street private equity firm was extracting more and more profits. Last year, the nursing home company went bankrupt. That didn't stop the private equity firm from making huge profits on their investment. That's what happens when leveraged loans and collateralized loan obligations and leveraged buyouts work as designed by Wall Street. Wall Street extracts the profits out of the company, the rest of us, workers, patients, family, and communities pay for it. Today, Wall Street looks for profits anywhere it can find them. These schemes squeeze money out of every part of the economy. It's not only healthcare. It may be a hospital in Philadelphia, Pennsylvania, or it may be a hospital in Massillon, Ohio. But it's also manufactured home communities in Iowa, and I have seen some of those where private equity came in and raised the rent 50%, and people are captive, having to live there at much higher rent that they didn't expect. It's manufactured home communities in New Hampshire also, not just harming individual families, but entire communities. Imagine how bad it will be if these complex financial transactions blow up like the subprime mortgages did in 2008. This is just one of so many challenges working families face. We got a report this week showing that almost half of American workers are stuck in low-wage jobs. 1 of 4 families spend more than half their income on rent and utilities. I know people sing about this economy, but think of this 10-year economy where growth has actually declined a bit in the last couple of years. But think about that. Almost half of American workers are stuck in low-wage jobs. 1 in 4 families spend more than half their income in rent and utilities. And you know what that means. If one thing goes bad in their lives, they lose their home. 40% of Americans are so short on cash, they'd be forced to borrow money to cover a $400 expense. Those are the people the 3 of you work for. You don't work for this president. You don't work for Wall Street. You don't work for the banks. You work in part for the half the population that can't come up with 40% of the population that can't come up with $400. More and more families have to borrow just to get by. Credit card debt, student loan debt, mortgage debt, all higher than before the crisis. Wall Street squeezes more out of every one of their paychecks, adding to their billions. If regular Americans are struggling 10 years into this so-called recovery, when the stock market is booming, what will happen when there is a recession? This can't be how the financial system should work. The regulator's job isn't to protect profits for big banks and big companies. It's to protect our economy and our financial system and the ordinary families that the system is supposed to serve, not the other way around. I guess when candidate Trump talked about draining the swamp, he really meant betraying workers and giving Wall Street free rein, as we've seen begin to happen, means betraying workers and giving Wall Street free rein to prey on them and wring every last cent out of our communities. The president uses his phony populism, racism, anti-Semitism, anti-immigrant slander to divide us, to distract us from the ways he and his hand-picked cronies have betrayed working families and left them struggling more than ever. It's not how a democracy should function. I'm deeply worried that if you, as the regulators, don't stand up for workers and our families, so many in our community, in our economy, so much in our economy and our democracy is at risk. Thank you, Mr. Chairman.
Thank you. We'll now turn to our witnesses, and I would ask you to give your remarks in the order I introduced you. We will turn to you first, Mr. Quarles.
Thank you very much, Chairman Crapo, Ranking Member Brown, members of the committee. Thank you for the opportunity to appear today. My colleagues and I join you on the cusp of a significant and shared milestone, which is the full and faithful implementation of Congress's efforts to improve financial regulation in the form of the Economic Growth, Regulatory Relief, and Consumer Protection Act. Today, I'll briefly review the steps we've taken toward this milestone, share information on the state of the banking system, and discuss the continuing need to ensure our regulatory framework is both coherent and effective. The Act was an effort to consolidate a decade of work on financial reform and a specific targeted response to the conditions facing today's banking organizations and their customers. It was also rooted, however, in long-standing congressional practice of reviewing the work done in the immediate aftermath of a crisis, of addressing any gaps, and of ensuring that public and private resources go towards their best and most efficient use. The Board's latest Supervision and Regulation report, which is delivered in connection with my testimony today, confirms that we have a stable, healthy, and resilient banking sector with robust capital and liquidity positions, stable loan performance and strong loan growth, steady improvements in safety and soundness, and several areas of continued supervisory focus including operational resiliency and cyber-related risks. The banking system is substantially better prepared to manage unexpected shocks today than it was before the financial crisis. And now, when the waters are relatively calm, is the right time to examine the efficiency and effectiveness of our protection against future storms. With last year's reform legislation, Congress made a significant down payment on that task, and in less than 18 months after the Act's passage, we have implemented all of its major provisions. Earlier this year, we completed a cornerstone of the legislation, tailoring our rules for regional banks and building on our existing work that firms with greater risks should meet higher standards and receive more scrutiny. We previously relied heavily on a firm's total assets as a proxy for those risks and for the costs that the financial system would incur if a firm failed.
We have all but three.
This simple asset proxy was clear and critical. It was rough and ready, but it was neither risk-sensitive nor complete. Our new rules employ a broader set of indicators to assess the need for greater supervisory scrutiny and maintain the most stringent requirements and strictest oversight for the largest and most complex firms. We and our interagency colleagues have also worked on a range of measures to address the issues facing smaller banks, with particular attention to the community bank business model. And our goal, through this period of intense regulatory activity, has been to faithfully implement Congress's instructions. But those instructions also speak to a broader need, and one central to our ongoing work, which is to ensure that our regulatory regime is not only simple and efficient and transparent, but also coherent and effective. Financial regulation, like any area of policy, is a product of history. Each component dates from a particular time and place, and it was designed, debated, and enacted to address a particular set of needs. No rule can ever be truly evergreen. Gaps and areas for improvement will always reveal themselves over time. Our responsibility is to address those gaps without creating new ones, to understand fully the interaction among regulations, to reduce complexity where that's possible, and to ensure that our entire rule book supports the safety, stability, and strength of the financial system. My colleagues and I are paying particular attention to coherence in our capital regime and in the full set of post-crisis reforms, to a smooth transition away from LIBOR and other legacy benchmark rates, to sensible treatment of new financial products and technologies, and to clear, consistent supervisory communication which reflects and reinforces our regulations and laws. My written testimony and the accompanying supervision and regulation report cover each of these areas in greater detail, and I appreciate the opportunity to discuss them with you today. Thank you, and I look forward to answering your questions.
Thank you very much. Chairman McWilliams.
Chairman Crapo, Ranking Member Brown, members of the committee, and fellow staff. Thank you for the opportunity to testify today. 18 months ago, I began serving as the 21st chairman of the FDIC. During this period, the FDIC has undertaken a great amount of work with a particular emphasis on three overarching goals: strengthening the banking system as it continues to evolve, ensuring that FDIC-supervised institutions can meet the needs of consumers and businesses, and fostering technology, solutions, and encouraging innovation at community banks and the FDIC. The FDIC has made significant progress in each of these areas, and I appreciate the opportunity to share our progress with this committee. Before discussing the FDIC's work to strengthen the banking system, I would like to begin by providing context regarding the current state of the industry. The U.S. banking industry has enjoyed an extended period of positive economic growth. In July, this expansion became the longest on record in the United States. By nearly every metric, the banking industry is strong and well-positioned to continue supporting the United States economy. While the state of the banking system remains strong, the FDIC is continuing to monitor changes in the industry and work to further strengthen the banking system by modernizing our approach to supervision, including outdated regulations and increasing transparency, enhancing resolution preparedness, assessing new and emerging risks, and creating the workforce of the future. My written statement details the many actions the FDIC has taken in each of these areas. While these efforts are steps towards a stronger banking system, there are certain areas in which the needs of consumers and businesses must be addressed by more comprehensive reforms. We have been working diligently to update our regulations governing broker deposits, which were put in place over 30 years ago. In addition, we're working with our fellow regulators to modernize the Community Reinvestment Act and provide clarity for banks seeking to offer loans that meet consumers' small dollar credit needs. Finally, perhaps no issue is more important or more central to the future of banking, and frankly the present, than innovation. Technology is transforming the business of banking, both in the way consumers interact with their banks and the way banks do business. Regulators cannot play catch-up, but must be proactive in engaging with stakeholders, including banks, consumer groups, trade associations, and technology companies, to understand and help foster the safe adoption of technology across the banking system, especially at community banks. Since 1933, the FDIC has played a vital role in maintaining stability and public confidence in the nation's financial system. This mission remains as critical today as it was 86 years ago. But if we are to achieve our mission in a modern financial environment, the agency cannot be stagnant. Last year, I began a 50-state listening tour to engage with state regulators, FDIC-regulated institutions, consumers, and other stakeholders. At the outset of this effort, I emphasized the need to reverse the trend of having those affected by our regulations come to Washington to have their voices heard, but instead to meet them on their home turf. With 26 state visits in 18 months, I'm now more than halfway through the listening tour, which has been incredibly informative and has underscored the importance of seeking perspectives outside of the Washington Beltway. I look forward to visiting the remaining states and learning more about the issues that matter most to consumers and communities across the nation. Thank you again for the opportunity to testify today, and I look forward to your questions.
Thank you. Mr. Hood.
Chairman Crapo, Ranking Member Brown, and members of the committee, as the 11th chairman of the National Credit Union Administration, I am honored to appear before you this morning, and thank you for the invitation. I've written a very detailed statement that you all have for the record, but in my brief moment to speak with you this morning for my opening comments, I'd like to talk about 3 areas where I think that we have mutual interest. One is the current state of the credit union system. Secondly, I'd like to talk about NCUA efforts to foster greater financial inclusion. And then third, I'd like to talk about cybersecurity. Ladies and gentlemen of the committee, strong growth trends in federally insured credit unions are continuing in 2019. Roughly 119 million members are a part of America's credit union system today. That accounts for roughly 1/3 of America being a part of a credit union. Credit union assets approximate $1.54 trillion through the end of the third quarter of 2019. Credit unions have also recorded a very strong aggregate net worth ratio of 11.39%. Roughly 400 basis points above the 7% statutory requirement. The Credit Union Share Insurance Fund is also healthy at this time, with roughly assets of $16.7 billion, well above the $10 billion level that the fund was at just over a decade ago. We also have posted a very strong equity ratio. Overall, year-to-date operating results evidence a very healthy and solid federal credit union system. I'd now, ladies and gentlemen, like to talk about NCUA's efforts to foster greater financial inclusion. I deeply believe that financial inclusion is indeed the civil rights issue of our time. Inclusion means not only broader access to financial services, but also to employment and business opportunities. We at NCUA have just launched the Second Chance Initiative, where our board voted on that final rule just recently, for nonviolent criminal offenders to have employment opportunities with credit unions. This creates opportunities for these individuals to climb the economic ladder and have opportunities for greater financial inclusion and shared prosperity. I agree with you, Senator Brown. It is troubling to read in a recent Federal Reserve survey that nearly 40% of American households cannot afford to pay for a $400 emergency. Even more troubling is that that percentage increases to 60% for families with a disability. This is why I am definitely pleased that NCUA and its board has approved PALS 2, a short-term, small-dollar loan product that serves as a responsible alternative to pernicious payday loans. These loans that we're creating through the PALS program are often being coupled with our credit unions with financial education, financial counseling, and coaching, further helping these individuals achieve access to broader financial services. Rural America must also be involved and included in financial expansion and inclusion. That is why I'm also pleased that NCUA has worked to provide hemp guidance to the agricultural community to help individuals learn how to work with this emerging business trend and reminding them of the importance of following the FinCEN guidance. Also, we recently provided regulatory relief regarding the commercial real estate appraisal rule, increasing that appraisal requirement from $250,000 to $1 million in response to some of the rural communities not being able to get appraisals done in a timely manner. Third, I'd like to focus on cybersecurity. Cybersecurity is a high priority for my chairmanship. Cyber attacks are indeed an acute threat that we as regulators must combat and face every day. I care about this issue so passionately that I have appointed a senior advisor to advise me and the industry on how do we, in the credit union industry, safeguard our defense mechanisms and really go through extra efforts to protect member owner data. This individual who is spearheading this effort is also providing cybersecurity training and outreach to assist our small credit unions, also utilizing new tools to better assist our examiners on looking at the levels of preparation of cybersecurity preparedness in our credit unions, and also working in concert with some of the other federal regulators here today. In closing, I would like to inform the committee that we are very grateful and appreciative of the work that you all did in passing Senate Bill 2155. I'm also pleased to report that NCUA has met all of the provisions that pertain to credit unions and especially the actions that we could take unilaterally. So if I look for opportunities to work with you in the days ahead, I would like to look for opportunities to promote greater financial inclusion, economic mobility, and shared prosperity in America's underserved areas. Thank you.
Thank you very much, Mr. Hood. And as I begin my questions, I've got a lot of them, more than we'll be able to cover in my 5 minutes. So I ask you, first of all, you should expect to get some written questions from me following the hearing. But secondly, I ask you to be as precise as you can in your responses. The first one is to Chairman Quarles and Chairman McWilliams, and I hope it'll just require a yes answer quickly from both of you. It's on the covered funds issue, and I just wanted to ask if each of you, yes, got it already, if each of you just commit that you will respond and resolve this issue quickly.
Yes.
Yes.
All right, thank you. We've got a good start there. Chairman McWilliams, on Madden. You indicated when the Madden decision came down that it has interjected certain uncertainty, significant uncertainty, into the secondary markets for loan sales in the Second Circuit and raises safety and security concerns. How does the FDIC's proposal address the confusion around the valid when made doctrine and support safety and soundness?
Thank you for that question. The FDIC's proposal basically does not change since the framework we had before Madden. Since 1828, there was a Supreme Court precedent that basically said when a loan is not, if a loan is not usurious when made, nothing subsequently makes that loan usurious. This Congress gave the national bank status that privilege as well in 1865, and then 115 years later in 1918. We got at the FDIC, we got the same opportunity to implement that into our statute. So we have had a long existing guidance implementing basically exactly that. It's the so-called valid when made doctrine that the court in Madden frankly ignored. They ignored almost 200 years of both regulatory and legal history. And so we were compelled to provide clarity, restating what we have had in place since 1980, frankly, at the FDIC, and our proposal does not change anything that we have had since 1980. The concern with Madden is that there are going to be implications for the secondary market that are frankly going to undermine safety and stability of the system and the soundness of our banks. If banks are unable to sell loans in the secondary market and have the sanctity of the contract carry over, there's going to be a disruption in the ability of the banks to basically be able to offload those loans if they need liquidity at a time of stress. And it's something that we, from the regulatory perspective, are quite concerned about.
All right, thank you, and I appreciate your attention to this.
Thank you.
Mr. Hood, this summer you publicly stated that the NCUA board intends to release a proposed rule to allow subordinated debt to be counted as regulatory capital for a broad range of credit unions by the end of the year. Can you provide the committee with a quick update on your progress on this rulemaking?
Yes, thank you for that question, Senator Crapo. This has proven to be a very complex issue, so we are still working diligently on the proposal because we really want to get it right. I really am, though, delighted that our aggregate net worth ratio for credit unions to date is about 11.39%, so we really do have a strong capital position now and I want to introduce other tools to further buttress that level of capital. But right now, we are still studying it and making sure we get a proposal right before we give it to stakeholders for comment.
All right, thank you, and I appreciate your attention to this as well.
Yes, sir.
And finally, Mr. Quarles, we don't have nearly enough time left to get into this issue as deeply as I would like to, but I want to talk about digital currencies. I understand that you are basically the lead at the Fed on dealing with our other regulators around the globe and working with others as they look at Libra and, frankly, at the digital currency issue, correct?
Yeah, the G20 has given the Financial Stability Board the task of considering the stablecoin issue, and as I chair the Financial Stability Board, that's my responsibility, yes.
Well, I'm very concerned. The Libra issue and Facebook presents one set of issues. Issues, but the digital currency issue is much broader, as I see it. And one of the big concerns I have is that the potential for digital currencies based on blockchain technology could ultimately undermine the role of the U.S. dollar in global markets. Do you share that concern?
I think that would be a very long-term concern if you consider the current proposals for stablecoins, those that rely on a basket of currencies to anchor their value or include a very heavy weight towards the dollar, just given the role of the dollar internationally currently, and that would be likely to be the case for some time. But over a long period of time, that would be an issue we'd need to think about.
Well, as other nations, for example, were to pursue that, wouldn't that give them the ability to basically try to start shifting away from the dollar, the utilization of other currencies?
If other currencies were more useful in the payment system, more useful forms of payments, again, I think it wouldn't be an immediate effect, but over a long period of time, that would be a factor, yes.
All right, well, thank you. My time's up. I got a lot more I want to talk with you about this, so both in conversation as well as in questions, I'll get further information to you on that. This is something I think we need to take a really deep dive on and rapidly. So thank you.
And
Senator
I'm hoping,
Brown.
Mr. Chairman, we can get a second round, too.
Sure.
Okay. Thank you. The private equity firm I mentioned in my opening statement, Mr. Quarles, is the one that cut staff at nursing homes and endangered documentation of endangering patients is your former employee, the Carlyle Group. You were a partner when this was happening, so I have to assume you're aware of it as Carlyle reaped huge profits from this. Do you think a system that allowed the Carlyle Group to load up a company with debt and extract management fees and cut corners and put patients at risk is a good system?
I actually wasn't involved in that transaction at all, so not wanting to speak about the details of that transaction, I do think that it's important that we have a system where private equity is bringing benefits to the companies it invests in and not otherwise.
Wait, not otherwise meaning if they're not bringing benefits, they should not be allowed to do it? What do you mean not otherwise?
We should have a system that creates incentives so that investors are improving the companies that they invest in.
So even though I heard your involvement in the Bush administration, you didn't seem to be too responsible for the economy imploding in those years, and now you're saying you were at Carlyle. The Carlyle Group benefited financially to a great deal in its takeover of that company and ManorCare in Toledo. So I guess I'd ask this then: what steps do you take now then at the Fed to rein in risks and make sure financial companies are investing in the real economy and creating jobs rather than this financialization and making reckless bets that hurt families?
Safety and soundness of the financial system is the responsibility of the Fed. That's an element of our supervision and examination of firms, and I think an appropriate element.
That doesn't seem very proactive. I mentioned private equity because they're the biggest users of the riskiest kind of leverage loans, as you know, which they dump on companies that they got for profits. It's been 6 months since I raised concerns in letters and in hearings over leverage lending. You've shifted from it's not a problem, your earlier answers, to we need more data. What specific abuses that are not already happening in leveraged lending market would you have to see to convince you to crack down on these risks?
Well, we have taken supervisory action with respect to leveraged lending, Senator. Earlier, it's not that we'd said that it's not a problem. I think we've been trying to draw a distinction between is there a financial stability risk versus is there a potential contribution to a future business cycle downturn of current underwriting practices. With respect to the latter, a focus of the last two shared national credit examinations, where all of the regulators together look at the largest loans, that are shared among a number of institutions, a focus has been leveraged lending and the evolution of underwriting practices, as to which we have had a concern, and I think they're familiar to most people here. In the first cycle, we indicated which of those practices we had concerns about, and then in the second cycle, if they were continuing, we took appropriate supervisory action against the firms that were underwriting leveraged loans in this fashion.
Yeah, I guess, Mr. Quarles, because of the background of you and other regulators, because of your experience prior to these jobs and your general support for Wall Street, I just don't share in the confidence that you're going to proactively do something about this. I mean, I understand you say if it's risk to the financial system, to the stability, that's one thing, but it's obviously more than that. Let me shift to Chairman Hood, if I could, for a moment. The NCUA is an independent federal agency, right?
Yes, sir.
Independent, okay. Do you agree that you, as chair of the NCUA, must act without control or influence from the White House?
I am deeply committed, sir, to maintaining NCUA's independence as a regulator.
From the White House?
As an independent regulatory agency, it's my duty to uphold that.
Including from the White House?
I am committed to ensuring that NCUA is an independent agency.
You don't want to say yes to that. Okay, I get it. I sent you a letter in October because I was concerned about the photo ops you were doing with President Trump at the White House at his golf course. Then I got this letter from your office this past Tuesday. Can you tell me who you were posing with in those pictures, in the first picture that you sent to us?
I'm sorry.
You have the picture right there. Can you tell us? It's a letter you sent us as a peculiar, perhaps, but a response. I'm not sure if the letter is supposed to be a response to my concerns or not. So who could you identify the people in that picture?
Oh, there are a number. These are speaking engagements. What I sent you, Senator Brown, was a listing of my activities in my first 6 months of meeting with stakeholders to talk about credit union issues, to foster greater financial inclusion and shared prosperity. There's a picture of me being sworn in, it looks like, with one of the leaders of the SBA. And then my swearing in was conducted by the Vice President of the United States. But those are pictures of showing stakeholder engagement. But then I also provided activities of the 7 months of activities where we have kept America's credit unions safe and sound. And the letter was meant to be an opportunity to meet with you to talk about regulatory accomplishments as well as any other issues you'd like to discuss.
Okay, I just am not sure you understand what independent regulator means. From your letter back to us, from your statements about speaking as a body, as from the NCUA as a body, and from your other activities with the president. So I hope the lesson you take from that, Mr. Chairman Hood, is that you are, in fact, independent from the person who appointed you, the administration that sponsored you, from anybody that might have influence on you. Thank you.
Senator Kennedy.
Thank you, Mr. Chairman. Thank you all for being here, and thank you for giving so much to our country. I'd like to use my first couple of minutes, Madam Chair, talking to you about industrial loan companies. You know what those are. They're basically banks, but they're not regulated like other banks. They're authorized at the state level. Some of our largest companies are starting to use these industrial loan companies to take deposits, for example. Competition is good. Competition is a moral good. But